Steinhagen, CEO and founder of Geneta and professor of enterprise risk management. Corporate insurance rates continue to rise for property, liability, cyber, and others, putting pressure on corporate budgets. For each of these policies, what should be included as coverage beyond what's required? And importantly, how high should the policy limit be? And what's the right deductible? It all depends on the unique and specific risk liabilities your organization faces. It's time to make your portfolio of insurance policies efficient. What makes an insurance policy efficient? How can we determine if one policy is more efficient than another? Consider this dollars per dollar insurance efficiency rate measure. The expected enterprise value protected divided by the annual insurance premium of the policy. The expected enterprise value protected is calculated as the expected enterprise risk liability with the insurance policy, as measured in net present value, minus the expected enterprise risk liability for self-insured, or whatever represents the least expensive, minimally compliant insurance available, also measured in net present value. As an example, if the annual insurance premium is $10 million and the expected enterprise value protected is $50 million, then the insurance efficiency rate for the policy is 5.0. This implies that every dollar of the annual insurance premium protects an expected $5 of enterprise value. Calculating the expected enterprise risk liabilities will require a probability-based net present value analysis. There are a variety of NPV modeling approaches we can use depending on the information available and the level of detail and the relevant data we have at our disposal. Let's consider using a basic risk matrix approach to demonstrate the calculation of the insurance efficiency rate of an insurance policy. Consider product liability insurance. We start by listing the issues that could lead to a product liability insurable event, such as false advertising and breach of warranty, and other issues that potentially could trigger an insurable event for the company. We create or use the company's risk assessment matrix, also known as a heat map, to assess each of the potential insurable events. As an example, consider a 5-point likelihood scale that provides definitions and descriptive language and, importantly, annualized probabilities for each of the scale distinctions. The impact scale is also a 5-point scale with an all things considered financial impact range for each of the impact scale distinctions. After reviewing all of the relevant historical information of the company, corporate forecasts, and the relevant industry-specific insurance information, a team of subject matter experts risk assess each of the issues that could trigger an insurable event. Issue 1, false advertising, is risk assessed as likely to occur with an annualized probability of 0.2 and with a, quote, insignificant impact of less than 50 million. Issue 2, breach of warranty, is risk assessed as highly unlikely to occur with an annualized probability of 0.01 with a critical impact of more than 400 million. The team completes the risk assessment of the 10 issues that could trigger a product liability insurable event. In collaboration with the company's insurance broker or other insurance providers, the company's insurance team identified the potential product liability policies available to the company in the insurance marketplace. The current policy has an annual premium of $9 million, a deductible of $50 million, and a policy limit of $180 million. A less expensive policy or downgrade has an annual premium of $1.5 million, a deductible of $50 million, and a policy limit of $30 million. A third potential policy or upgrade has an annual premium of $13 million, a deductible of $50 million, and a policy limit of $320 million. The cost of self-insuring is about $1.5 million per year, accounting for required certifications and operating expenses. The three product liability insurance policies are analyzed to determine how much they each reduce the company's expected risk liability as measured in net present value, and to determine their associated insurance efficiency rate. The current policy reduces the expected risk liability from $49 million to $34 million and has an insurance efficiency rate of 1.65. The downgrade policy reduces the expected risk liability from $49 million to $36 million and has an improved insurance efficiency rate of 8.75. The upgrade policy reduces the expected risk liability by about the same as the other two policies, but is much more expensive and has a reduced insurance efficiency rate of 1.29. Overall, downgrade is the most efficient product liability policy with an insurance efficiency rate of 8.75, while also resulting in a comparable reduction in product liability expected risk liability. Considering cyber insurance, the company's insurance team performs a similar exercise, identifying the issues that could trigger an insurable event, performing a risk assessment for each of the issues, and working in collaboration with the company's insurance broker or other insurance providers to identify the potential cyber policies available to the company in the marketplace. The company faces a significant cyber expected risk liability of $166 million. The four potential cyber policies have significantly different reductions in cyber expected risk liability, with the high-grade policy taking the biggest bite out of the company's cyber risk liability with an $88 million reduction. The policies also have significantly different insurance efficiency rates. However, all the rates are high and represent good returns on investment for insurance. The current policy has the highest insurance efficiency rate, but doesn't reduce the expected risk liability much. High grade has both a significant insurance efficiency rate and the greatest reduction in cyber expected risk liability. As a third policy, let's consider marine cargo insurance. Again, the insurance team performs a risk assessment of the issues that could trigger a marine cargo insurable event and works with the company's insurance broker or other insurance providers to identify the potential marine cargo insurance policies available to the company in the insurance marketplace. Three potential policies are identified. The upgrade policy with a $5 million annual premium is too expensive as it has a negative insurance efficiency rate. The downgrade policy is most efficient with an insurance efficiency rate of 3.17. Let's consider the performance of the portfolio of insurance policies the company currently holds. The product liability annual expected risk liability is about $49 million. The current product liability policy reduces the expected risk liability to about $34 million. The net present value gain of the policy is about $14.82 million, calculated as the current policy expected NPV minus the self-insure expected NPV. The insurance efficiency rate of the current product liability policy is 1.65, calculated as the NPV gain divided by the annual premium. The current cyber policy has an insurance efficiency rate of 14.86, and the current marine cargo policy has an insurance efficiency rate of 1.19. To calculate the insurance efficiency rate of the portfolio of current policies, we take the aggregated NPV gains of the three policies and divide by the sum of the three policies' annual premiums, resulting in the insurance efficiency rate for the book of three policies as 2.67. Considering the performance of the set of efficient insurance policies, the efficient product liability policy has an insurance efficiency rate of 8.75. The efficient cyber policy has an insurance efficiency rate of 7.38. And the efficient marine cargo policy has an insurance efficiency rate of 3.17. The portfolio of efficient policies has an insurance efficiency rate of 7.23. Let's consider a graphical comparison of the current portfolio of policies to the efficient portfolio. On the horizontal axis, we will accumulate the annual spending on policies. On the vertical axis, we will accumulate the annual risk reduction as measured in NPV gains. We prioritize the insurance budget based on the insurance efficiency rates. For the current portfolio of policies, the cyber policy has the highest insurance efficiency rate of 14.86. We then add the product liability policy, and thirdly, the marine cargo policy. The budget for the three policies is $12 million, and the reduction in expected risk liability from the three policies is about $32 million as measured in net present value gains. Comparing the current portfolio to the portfolio of efficient policies, the efficient product liability policy has the highest insurance efficiency rate of 8.75. We then add the efficient cyber policy and thirdly, the efficient marine cargo policy. The budget for the three efficient policies is $14.5 million, and the reduction in expected risk liability from the three policies has ballooned to about $105 million. Switching from the current book of policies to the efficient policies adds $2.5 million to the annual budget, but reduces the company's expected risk liability by nearly $73 million. The efficient insurance portfolio protects over 3 times more enterprise value. Your company's insurance policies should be capital efficient from an enterprise value perspective. We're here to help you accomplish this. Thanks for watching.